good morning everybody and welcome to today's webinar on COVID-19 Annual Super. I'm Olivia Long, Managing Director of SMSF, and today Jonathan Bayes, our Chief Investment Officer, will be presenting along with Cam Morcher, one of our partners in the Wealth Division. Firstly, I hope you've all enjoyed and had a happy and safe and quiet Easter. If you're anything like Jono and I, we're all ready to throttle the children. And most of us are starting the new world of homeschooling, so certainly challenging times all around for most of us at this point in time. Now, before we start, just a general note that today's presentation is a general nature only. So I'll hand over to Jono now and let you provide the disclaimer and take it away.
So I've got the control, Liv, I presume. I just got to do the share screen thing.
Yes, yep.
I should have remembered how to do the share screen thing, shouldn't I? Here we go. Okay, hi everyone. There we go. Hopefully that's all nice and easy for everybody to see. I hope you're all well. Thanks for giving us half an hour or 45 minutes of your time. I hope you're not going stir crazy, as they've said. For those of you that have sat in on the last couple we've done in the last 3 or 4 weeks, I've tried to change the presentation up a little bit. There's probably only 1 or 2 slides that you might have seen before. But with everything changing as quickly as it is, hopefully, you know, most of the content is reasonably fresh for you. The presentation has probably moved on a little bit from assessing COVID-19 and our response to it. I think it's important that we address a couple of issues, but most of this presentation is just to go into portfolios and why we feel the way we do, and why we're doing what we're doing with the portfolios at this point in time. The main thing that I guess I wanted to address is just the rapidity of the bounce back in markets, and just to make the comment that we haven't participated really much in the bounce back, in large part because we don't foresee a return to the bullish markets that we had in the lead up to the virus outbreak, and think there's still a huge amount of uncertainty to play out in the coming couple of months in markets, and we'd much rather be certain in where we allocate the cash than simply hastened into buying the market just because it's bouncing and the Fed have provided the amount of liquidity that they have, and all the usual reasons why people have bought bounces in the last decade. We think that this crisis is likely to be a very different one, and that the stimulus measures that the government and central banks are using at the moment are likely to have less of an impact than they've had in the past. So that's why I've sort of started the presentation by saying why the rush. You know, it was one of the fastest sell-offs in history, and we've seen subsequently one of the fastest rebounds back in markets. In the last 3 weeks, we've seen, including last night's gains, which were very strong still, you know, 2/3 of the market sell-off being recouped in the NASDAQ. Over half the sell-off in the S&P has been recouped. The Aussie market has recouped a little less than that, in large part because the currency's been rallying, and that's sort of taken a little bit off the top. And there's been a big rally in credit across the board, but largely in the higher grade and higher grade junk debt, if there can be such a thing. So a non-investment grade, but not the really horrible stuff like the CCC paper, which you can see from the presentation there, is actually only bounced about half what some of the better grade stuff like the double Bs have bounced. And you know, we said, and a lot of people have said, because I think it's the right way to look at these things, that, you know, credit, i.e. high yield corporate bonds, will be the leader of the market on the way down and the leader on the way out. And that's because there's just a huge amount of corporate leverage in the system at the moment. And so when the Federal Reserve last week announced the $2.3 trillion plan to support not only municipal governments, but also to the mortgage market and the high yield bond market, that was what gave all risk assets, so equities and corporate bonds, the last leg up that we've seen in the past week. And just the one liner for everybody there is that the Fed, for the first time, have said that they will support junk bonds, the higher rated junk bonds, that is, by buying any investment grade bonds that subsequently, on account of the coronavirus, were downgraded to junk. They would support them in the aftermarket, and basically along the lines of what a lot of the Fed and other central banks around the world, like the ECB and the like, are doing, is again just trying to provide that liquidity bridge to companies that may have seen a significant impact on their cash flows from the coronavirus, and trying to ensure that capital markets remain open to them and that they can access liquidity and try to forestall any solvency issues they may have had brought on by the virus. Part of the reason why we're not overly excited in the medium term by what the Fed are doing here is because it won't absolve any solvency issues that these companies might have, and I think that they will be very significant in the next 6 months on account of the damage done from the quarantining measures. And so, as I say, I think it's probably a bit of a band-aid on a situation that has quite a risk to the economy. But as I say, in the very near term, markets have taken heart from it, and that's been one of the real drivers in the last week or 10 days anyway for the bounce we've seen in markets. This just gives you an idea between the quality difference in the rally in high yield in the United States over the past 3 weeks since 23rd of March, when we made the lows. The white line is the overall high yield index, and so that includes all the various grades of corporate bonds below BBB. And then the red line is the specifically CCC corporate credit, which is the one of the lowest rated credit classes. And you can see that broadly speaking, the high yield market has bounced more than the lower grade stuff. And that speaks, I think, to the market's continued concerns that despite the liquidity injection we're getting from the central bank, there are still some really significant solvency issues that the lower rated companies are going to have on account of the economic demand destruction inflicted by the shutdowns for the coronavirus. The one main reason, amongst a variety of reasons, but the one main reason that we continue to be a bit reticent in applying the liquidity we've built up is simply because the virus is still so poorly understood. I've spent the better part of 2.5, 3 weeks on Twitter, 8 hours a day, reading various papers and opinions and the like. And the one thing I take away from all of it is, at the moment, it's very speculative. Some people have got good grounds for their speculation, others less so. But the reality, as I see it, is that the understanding of the virus is still very, very new. And that every other day I'm reading a different paper or different observations from different parts of the world as to how the virus is mutating, how it might be treated, whether there's been consistency in antibody testing, what those antibodies may do to protect people and for how long. And the reality of it all, as I can, from what little I can pass of the information, is that it's still desperately unknown. And as a result, the path out of the current quarantine, I think, is likely to be very staggered and probably more elongated than we're all prepared to give credit to. The one panacea to all of this is vaccine development. And, some vaccines have taken well over a decade to create, but I think that there's a widespread belief that A vaccine's likely to take between 1 and 2 years to bring to market in size. There's a very successful lab at Oxford University whose head, Dr. Sarah Gilbert, came out on Friday in the Financial Times in the UK and said she was 80% confident that she would have a credible vaccine for September, and that the UK government are doing all that they can in their ability to support her R&D, and in particular to support early manufacturing of a potential vaccine. But the likelihood in terms of getting the size of manufacturing done on a successful vaccine development means that, you know, it's still very, very unlikely that it would hit all of us in all the various countries around the world before Christmas. And that seems to be the most optimistic timeline from what I can make out. But again, back to the point of uncertainty, even as early as yesterday, you know, there were really quite credible reports talking about evidence of gene mutations in the virus in China, which might render the vaccine development more difficult than people would expect it to be. So, as I say, this uncertainty is unlikely to go away anytime soon, because we just need to do a huge amount of additional testing. Again, the antibody testing and the scale of the testing required in order to allow this idea of immunity certificates or passports is enormous. And again, there's been many tests currently used, but you know, as you probably saw the headlines about the tests that the Brits bought from China, there is a huge question over the quality of some of the tests, which would render the whole point of you know, antibody testing redundant if you can't trust the data coming through. I've got a couple of charts in there which I'll show just the size of the testing that's been done around the world to give you some idea of how insignificant it is in the overall scheme of the world's population. As it stands, as recently as the weekend just gone, each of France, UK, India and Australia extended their quarantine periods into May. As a bit of a guide, we're all watching the United States because Mr. Trump is very keen to get the US economy up and running again. Larry Kudlow, the economic advisor to Mr. Trump, was sort of talking last week of a 4 to 8 week period, which would put us deep into May, I think. And again, they were willing to concede that it would likely be a staggered reopening of the US economy, potentially doing it in states where they've not seen mass breakouts, and those cities like Los Angeles and New York and you know, the state of New Jersey and Chicago maybe would be slower to open up. But again, it's going to be very staggered and a lot slower. So this is just some testing numbers. All of this data is available on the internet. I'm more than happy to share the addresses that you can find this on. This was as of yesterday, but it just gives you a guide to the number of tests that are being done in various different countries. And in the United States, they've really picked their game up in the last week. They're now running at about 150,000 tests a day. They want to be getting north of 150,000 tests a day to really start to build out their data bank. But interestingly, if you take a look through the rest of the countries there, you can see that there are some sort of real successes and potentially some key concerns. But even the successes are still only testing, like Australia as an example, less than 2% of the population. And so it's very difficult for all of these experts in the field, as I say, to make assessments on the virus when such a huge part of the population is yet to be tested, and you know, for people to understand you know, how the virus is, how long the virus lives in people, all the various issues of symptoms and the like. The notable number that I take from this one, just to flag, is the second bottom country there, India. Brazil would be another country there of concern as well. Their testing is as low as India on a per pop basis. And I'll flag it up as we go through the presentation, but you know, clearly one of the big concerns on a variety of different levels is what this virus could do in emerging markets. India don't have many cases, but the reality is widespread testing has not been available there. And, this is a country that's already been in lockdown for 3 weeks, has another couple of weeks to go, but, they are not fortunate enough to be able to sit in quarantine for weeks on end, given the overall wealth of the country. So I do think that through the course of our winter, the northern summer, that the emerging markets have the potential to be really quite a big risk to the world economy as well. This is an awesome chart. Again, I flag it up in part really just to show you how much data is out there at the moment that is actually publicly available for us to assess what's going on in the world. Many of you probably have seen the TomTom traffic data that I've used on occasion, which I'll use again later in the presentation. But this is some data that's been built by a company in the United States to assess mobility of the population in various different states and to give them a bit of a mark on how mobile they are now compared to how mobile they were back before the quarantining issues went in. And it's I won't go into all the details because, truth be known, I don't fully understand the entire algorithm, but it basically measures your mobile phone ping, and it assesses, as I say, how much movement in the mobile phone that you've got during the day relative to where you live. And you can see there the purple line at the bottom is just the change in average mobility, which is down about 45%, pretty consistent there in the last 3 or 4 weeks. But what's fascinating about this data is that it shows which countries have been sticking to the quarantine, which states have been sticking to the quarantine and which ones haven't. And you can see, again, that swathe of orange in the south. Arguably less population density there, but that's really the potential hotspot for further outbreaks of COVID-19 in the United States, because the social distancing and the like has been perhaps less adhered to in those states. This is just, I thought this was a good one. I'm not going to go through all the details of it, but Morgan Stanley very kindly put together a timeline which most people I've seen with a view on these things have assessed it and said that it's reasonably credible. This is just the timeline for, when we get the sort of testing that we need for antibodies to really start building up our knowledge base on the virus, and when in the United States anyway, we're likely to see employees returning back to work, and in what sort of capacity, and when potentially, we may get a second wave of infections kicking in towards the northern winter again at the back end of the year. Again, I'm more than happy to flick that across to you after the presentation should you require it. So with all of that said about the uncertainty and just how the economy gets restarted, etc., the biggest things that, or some of the biggest things that concern us is what we return to on the other side of COVID-19, if you will. What damage is done to the consumer psyche, what damage is done to the world economy in terms of the debt that's accrued. And there's a variety of things that are really quite credible risks, and which lead us to believe that, again, this is just not going to be a very short and sharp hit to the economy and then a subsequently short and sharp rebound back. This is going to be the biggest recession since the 1920s, as we've all read. It's going to have a huge impact, I think, on household consumption and people's attitudes to their financial position. Historically, there's huge evidence that post-recessions we go into savings mode, saving for a rainy day, and as one of the charts coming up will show you, the US savings rate doubled in the wake of the GFC. I think that coming out the other side of this, there will be a very significant bias towards retaining cash, both within households, but also at a corporate level, which we'll touch base on in a minute. The other issue coming out the other side of this is going to be who pays for this stimulus. Again, I'll touch base on it later in the piece, but as we went through the GFC in Australia, we actually had no debt. This time around, we're going to come out the other side with probably around $600 billion worth of debt. In the United States, the debt to GDP ratio is going to go up from 80% to 120% in the space of 3 or 4 years, which is sort of twice the rate of growth that we saw post the GFC. We've got issues in so far as supply chain risks now with a really big theme emerging in the last couple of weeks being protecting your supply. It's really focused a lot on the medical side, obviously, in the last week or two. But I do think that as the US and China escalate their tit for tat, which is already starting, as we know, with the finger pointing, I do think that firms are really going to want to protect themselves by controlling their supply chain more, which means that just-in-time inventory internationally, I think, has probably seen its peak. And it just means that rather than getting the cheapest and most efficient provider of a service to do it, people might actually pay more just to have the safety of owning their own supply chain, or at least feeling like their supply chain is more predictable. Emerging markets have been a huge source of growth. And as I said before, it'd be fascinating to see how India and Brazil in particular emerge from the virus and what damage is done to the emerging markets consumer. Again, the center of the global debt bubble is Europe. Even in the last week, we've seen a disagreement between the southern European countries, notably Italy, but also to Spain, and the disagreement between them and their northern colleagues, if you will, over how to fund the enormous amount of debt that's going to be accrued in keeping their economies afloat this summer. Italy has net debt to GDP of 130%, but it's rapidly pushing up to 140, 150% at this point in time. And at some point, the concern becomes the solvency of Italy as a nation state. And given that the whole European financial system is based on interlinking ownership of one another's debt through the financial system, the knock-on effects aren't worth thinking about there. So we're going to need to see a resolution there. But there are huge nationalist considerations to take into account. Oil demand is another thing. I mean, again, we go back to the junk bond bounce that I talked about very early on. Oil companies, they're less than they were, but they're still 10% of the high yield index. And we've got oil now at $21 a barrel. Again, big emerging market economies such as Brazil and Russia are dependent upon the oil price. And so there is a huge hit to revenues in emerging markets and potentially a very substantial solvency risk for junk bond investors on account of where the oil price is at the moment. And just as a guide, guys, and you might have actually seen this, but basically airline travel at the moment is down about 80%, and automobile travel, if you will, globally is down about 40%. The two of these comprise about 60% of all oil demand. And so on roughly the 100 million or so barrels of oil demand a day, the market is running with about a 20 million barrel excess. And there's concerns that there might not even be the capacity to store it at the moment, at which point, you might see oil down into the $10 or $15 a barrel range. Oil is a very big deal for markets at the moment. And that was, I think, in large part why the president was trying to orchestrate an agreement in reducing the excess of supply, which 10 years ago would have been unheard of. Trying to orchestrate higher oil prices on the US consumer. The last issue there, because I feel like I've gone on a bit on this chart, is just again the presidential election in November, and you couldn't have two. Well, outside of Bernie Sanders, of course, you couldn't have two more polar opposites in terms of policy between the two candidates. And I think Bernie Sanders' endorsement of Joe Biden is a good thing for the Democrats. But we've had a very freewheeling capitalist agenda under President Trump, and were the presidency to change, there would be quite a significant change, I think, in the attitude to investment markets under a potential President Joe Biden. And that's increasingly an issue given that November's only 6 months away. So there's a variety of those issues. This is just the chart that I flagged up to you earlier about the savings rate. You can see there in the third column, 2005 to 2009, just how the US savings rate went from 4 to 8% within the space of a couple of years after the GFC. You know, behaviours do change. You know, this is another interesting chart that I referred to the TomTom data earlier before, and I think this is really interesting too, because this just shows average congestion this last week in Beijing. And I flag Beijing because, you know, it's not Wuhan, but you know, things are back to normal, as you can see from the red spikes in the weekdays. You know, largely speaking, back to the levels that they were at last year. But the big notable drop is in those Saturday and Sunday traffic congestion figures, which just goes to show that on the weekends, Beijing residents are choosing not to go out. And so this is, again, this issue of trust now that is likely, I think, to cast a pall over our return to, you know, normalcy. Once we do come out of quarantine, I think that, you know, we were just talking between Liv and Cam and myself before, you know, it'll be great when we get a bit of freedom back, but I really don't think many of us will be utilising it to the full extent because of that trust and suspicion as to the transmission of the virus and our ability to control it. The big thing for us locally here is just to make the point, and it's really relevant, I think, because there have been some suggestions about, you know, how profitable 2009 was for investors in Australia, how the recapitalisation of the market was just a wonderful opportunity for people to buy into really good quality companies, and who then subsequently had a really strong couple of years of profit growth as interest rates were cut. It's not going to be the case here in Australia, I'm sorry to tell you, this time around. We really have precious few levers to pull to re-stimulate the economy here. And so I've just thrown up there the comparatives. You know, 2008-9, interest rates were significantly higher than where they are now. We're now at virtually zero. You know, we had net cash in the bank as a sovereign government. We're now at 20% debt to GDP, rising to 30%. Again, I would still say, though, guys, that's still very, very low compared to the rest of the world. Household debt to income has obviously escalated significantly. We've seen house prices really provide a ballast, I think, to household confidence over the last decade here. And perhaps had we not seen that rally in household prices, the economy might even be even worse. We also had the currency at a significantly higher level than where it is now. And as you've seen from past presentations and things we've written in the last week or two, you know, one thing that we do feel quite strongly about is that the Aussie dollar has found a low, and certainly in the last 2 to 3 weeks we've been correct on that. And then the big stimulus that our resources sector got as China re-leveraged its economy back in 2008-9 isn't there either. You know, China's steel production's already doubled in the last decade. Steel inventories in China are 50% above where they were this time last year. So the point of it all is that there's not an easy fix. And in order to re-stimulate both our economy and the economy globally, we need to get people out there spending. And I think this is the issue that we face now, is that you know, interest rates are at zero. Government debt is significantly exploded. Certainly in this country anyway, household debt is very, very material. It's hard to find a catalyst to stimulate demand, and on the basis that demand is driven by the combination of, you know, people, capital stock, and productivity. You know, we're not going to increase immigration. There's not any more capital stock here in this country, and arguably, I'm going to make this point in a minute. Productivity here and around the world, I think, is set to plummet. It doesn't give much grounds for optimism on a likely a strong rebound in economic growth. You know, this is just again where we're starting. Business confidence has never been this low in this country before. The white line is confidence, and the red line is business conditions. And you'll note there that both are below where we were in the GFC. And this is where, or maybe just to sort of conclude on things before I move on to a couple of other points. You know, the uncertainty, I think, is still there. It's very hard for us to get through. Massive debt overhang, both at a government and household level, I think is going to be a real factor in holding us back. But, you know, once again, we're very fortunate that we're Australian and living in an island country where we can close our borders in the manner that we have. And again, in a country where we don't live on top of one another, really makes us extremely fortunate in the world at present. I'll talk to the value that's emerged in the market over the last couple of months. This is a view that we've had for the last 3 or 4 weeks. As I say, we've not really fired any bullets at all because of the uncertainty around, but we're still there with quite a lot of liquidity that at some point in the next 3 to 6 months we will be looking to add to portfolios. But as I say, we don't feel overly rushed to do so, particularly given the speed of the bounce back we've seen in the last couple of weeks. Now, this is the bit that I really want to get to, because I think this is actually really, really important. And this is, to be honest, I've stolen this off a former colleague of mine because I just think it surmises the current situation incredibly well. And so when I say the equity value of resilience is a lot less than the equity value of efficiency, what I'm trying to say, paraphrasing the colleague of mine, is that in the previous decade, with interest rates very low, balance sheets across the world, corporate and household, have been incentivized to be optimized. In other words, with low interest costs, it's better to take on as much debt as you possibly can. And that has helped goose valuations of share markets around the world. You may have read in the past the significance of share buybacks to overall earnings per share in the United States, which in the last 15 years has been very significant. They've contributed, I think it's been about 11% annual earnings per share growth in the US in the last 15 years, of which 3% has come from companies buying back their own stock. So there's been a real optimization of balance sheets. The new world is going to be very, very different because of that desire to protect your supply chain, to ensure that, you know, if we get a stop-start rebound back to the economy because we can't get a control of the virus, that we want to have more cash on the balance sheet. Again, even if you just think in really simple terms, you know, bringing staff back on after the quarantine period in a month or two's time, you know, we're not going to see 100 out of 100 staff walk back into offices and manufacturing floors and shops. There will be a significant staggering, I think, in the number of people in the workplace. You know, restaurants will have less tables in there. You know, there will be staggered start times so that public transport isn't overwhelmed. All of this is going to have a very material impact on the productivity of economies, and that will have an impact on ultimately the profitability of economies. You can see there in the top line, a return on equity will be diminished. And the comparable is to the banking sector post the GFC. And my former colleague was one of the best banks analysts that I've ever worked with, Mark Rubenstein, who made this remark about it. And it's because he's had experience in watching it with the banks. Post the GFC, banks were told by regulators around the world, we cannot have this happen again. You were running too efficiently. You weren't holding enough capital to absorb the losses that you did. In the future, you will hold more capital. And so banks have done that. And as a result, we've seen a significant derating in the banking sector over the last decade because returns have fallen. And I think what we're going to see in the rest of the world is much the same thing happening, because again, we're going to put a premium on security of supply. We're going to put a premium as businesses on ensuring that we have enough cash flow to ensure that we can last should we get put into quarantine again. As I say, that's going to make corporate balance sheets significantly less efficient. And that means that ultimately equity values are going to be less than what we've seen in the last decade. And I think it's a really, really credible argument that over the course of the next few years will play out. It'll be very, very hard for us to achieve the valuations that we've seen in the lead up to this unfortunate crisis. And this just shows again the optimism that the brokers have got with how quickly they believe we'll return back to normalcy in the United States. And you can just see the S&P EPS figures there over the last couple of years. Interestingly, they're 2019, courtesy of the trade war, largely flat on 2018. But within 2 years in the US, expectations are that we'll return back to the level of profitability we had in 2019. And again, remembering, of course, that that's despite the issues I just raised on the previous page. Despite the fact that we're going from what was a record low unemployment in the United States, 50-year low in unemployment at 3.5%, to what probably, as of this week, will be pushing 20% unemployment, but still rising. And again, I don't have the exact stats, but I'm sure you've all seen the remarks about the number of households, unfortunately, in the United States who don't have more than $200 or $300 of cash in their bank account at any point in time to be able to suffer crises like what we've seen. This just shows, and this speaks to the speediness of the bounce we've seen in the last couple of weeks, what we've come to know as the Fed's playbook, which is just, again, to buy asset markets. And a staggering injection of capital in the last month by the Federal Reserve there on the right-hand side. The balance sheets jumped by $2 trillion in the space of 3 weeks, with the Fed in there buying bonds across the board as a means to ensuring liquidity into the financial system. That's been one of the factors, I think, helping equity markets push higher in the very near term. Historically, over the last decade, the saying, don't fight the Fed, has been very, very true. And as a result, investors in the last couple of weeks have taken to that playbook and again bought the market. As I say, I think it's going to be a lot more nuanced this time around. This speaks to the economic destruction that's gone on. This was a survey done in the United States by Data for Progress, which is an organization in the States. Was done as of the end of last week. I just draw your attention to the bottom bar charts, which show that 60% of all under 45-year-olds have either lost their job, been put on leave, or expect to either lose their job or be put on leave, which is staggering. It's absolutely staggering. And again, if you just think of the knock-on effects as to what this is going to do for household cash flows and the like, you'll understand why there's not a very instantaneous snapback coming. It's again, I could say unprecedented, but we did see it back in the 20s, obviously. Jobless claims numbers, it's almost an irrelevant chart here because the line on the white is just so significantly above any numbers historically. But again, for those of you that saw my presentation a couple of weeks ago, you'll know previous high in terms of new weekly unemployment benefit claims was about 800,000, happened twice back at the GFC and the other time in the early 80s. The last 3 weeks we've had 3.5 million, 6.5 million, and 6.5 million. So 17 million people in the US, and they're expecting another 6 million this week to sign on for the dole. 23 million people over 4 weeks out of a total US workforce of 160 million people. So instantly, 14% of the workforce are signing on for benefits for the first time in their life. But despite it all, and this is the thing that we've been talking about as an investment committee, consumer confidence in the US is still above, well, really, it's come off the highs, but we're talking about, and the chart doesn't go back that far, but it's 20-year highs. Consumer confidence is still higher than it was a couple of years ago. So I do think that the US population, probably focused more in certain parts of the country, really believe that this is a media concoction, a beat up, and that the world is going to return to normal really quickly. And this is a nagging thing in the back of my mind that I think concerns me again, that they haven't really realised, despite the huge number of deaths in places like New York and the like, that this is going to be a very lasting impact on their economy. Time to move on to valuations again, which certainly are more supportive in Australia. They've become less compelling just because the market's about 10% higher than it was when we first started looking at things 3 weeks ago. But we're encouraged that for the first time in really a decade, there is a reward being offered for taking risk. And this is just a chart of high yield bonds and the rate of income you get there relative to cash, and the spread there. And you can see going into the start of the crisis that the spread was down in the 3.5% range, which really isn't a huge amount of reward you're being offered for taking on board risk in junk companies. It jumped to about 11% a couple of weeks ago when the market was at its lows, and it's now back into just under 8%. The risks are certainly significantly higher, and that's again something which is holding us back in terms of aggressively buying the market. But we can't deny returns are now starting to reward us, if you will, for taking that risk. This is just long-run equity valuations in the United States. Again, things there aren't as cheap as you'll see on the next chart as they are in Australia. This is just a long-run price to earnings, which is in the low 20s in the United States, which is still above the 10-year average post the GFC. You'll note, which, as I say, doesn't make me feel like valuations in the United States are particularly attractive at all. Compared that to Australia, on the other hand, where we are below the 10-year average, and when markets were back in the high 4,000s to 5,000 range, and it started to settle, we were probably only about 10 to 15% above the valuation low point we got back in the GFC. And I would say that that valuation support is a good thing, but back to that point I raised earlier, I think that it's going to be very hard for us to see a very significant economic rebound back in the next couple of years. So again, trying to balance out that value is improving, but as I say, the outlook is still very cloudy. And just to finish off, guys, just to give you some sort of sense of what it is that we're doing and how we're viewing things, we do think that this excess productive capacity is going to become a major theme. We do think it's going to have an impact on equity valuations because earnings growth is going to be far more difficult to achieve. You've probably heard people talk about the world turning into Japan, and I do think that there's elements of reason to believe that view. There's an argument that a famous economist in Japan, Richard Koo, made about a balance sheet recession occurring, which is what happened post the GFC and also happened to Japan a decade earlier. And there's every likelihood, I think, that we're going to face those similar attributes, I think, as an economy in the years ahead. And it just means that once you've got so much debt on your balance sheet, it doesn't matter how low interest rates are, you don't want to borrow anymore. You want to pay down your debt, even though it makes precious little sense to do so. And I think that there's a lot of risk that the world economy, and Australia in particular, is going to head down that path for a couple of years. So that's why, again, I go back to that chart I showed you earlier of the huge Federal Reserve stimulus that's been pumped into the market in the last couple of weeks, and my belief that it's actually going to have far less bang for its buck in a global economic sense than it has done in the past. Supply chain issues I've talked about on a couple of occasions already. Consumer recession, I think, is a shoe-in here. And so what we're ideally hoping to do in the coming couple of weeks and months is to really upgrade the quality of the portfolio. And I think that probably the near-term thing that we're doing, we've done a little bit and we will continue to do. You'll probably get some further words from me later this week on it. But we'll probably suggest that we use this rally that we've fortunately had in the last 3 or 4 weeks to sell out some of the cyclical exposures or the leveraged exposures that we got caught holding when the virus hit. The one part of the portfolio that for us has been disappointing has been the Australian equity portfolio, where we've given back all the outperformance that we had in 2019 and probably a little bit more, and actually underperformed by around about 10%, which is quite disappointing to me, and really undid a lot of the good work we did on the asset allocation side and on the international equity side, which means that we're probably still outperforming the benchmarks very marginally, but we would have liked to have outperformed a lot more. And I think that as we improve the quality of the Australian equity portfolio in the coming couple of months, we'll really start to see the outperformance that I think our good asset allocation should have delivered really start to come to the fore in performance terms in the remainder of 2020. And so this is just us, again, being brutally honest and giving you the performance of the two key portfolios over the last 3, 6 and 12 months. I'll focus on the balanced portfolio specifically because I think most investors, the largest cohort of investors, tend to be balanced investors. And you can see there that, in the last 1, 3 and 6 months, we've actually been a shade behind the benchmark, albeit the majority of fund managers are behind that benchmark, regrettably, the last 6 months. But again, probably 2 to 3% of that total portfolio has been impacted by the Australian equity piece. And as I say, I'm pretty confident that we'll get that back ship shape in the next couple of months, which means that I'd like to be talking to you in the second half of this year with genuinely a good 2 or 3% outperformance under our belt in what will go down as quite a tricky year. Again, the long-term performance numbers, as you can see, are sound, but I'd much rather focus on the near term. And as I say, I think the Aussie equity portfolio has been the one part that we've been disappointed with, and I do have quite high expectations that can be repaired in short shrift over the next couple of months. I think that's it from me, Liv. So I might hand it over to you if I may.
Sure. We'll just flick it to the next slide, and that's fine.
Of course, there you go.
Yeah. So just for everybody that's online, we will now open it up to questions, which we'll answer once I've gone through the superannuation details. But if you've got a question for Jono or Cam, click on the Q&A button in the middle of the bottom of your screen and send through any questions that you'd like answers on, and we'll get to them shortly. But if we talk about the superannuation components that directly impact not just on SMSF but on super in general, the first thing I'd like to talk about today is the $10,000 early access relief that the government have allowed. So essentially the government is saying for eligible people that they can access or withdraw $10,000 from their superannuation prior to 30 June and another $10,000 from their super account from 1 July until I think it's around the end of 24th of September 2020. So to be eligible to access your superannuation, and I'm sure your advisors would recommend that you look at all other means of trying to make your way through the situation at present before withdrawing from your super, if possible. To be eligible, you need to be unemployed. You need to be eligible to receive a job seeker payment, youth allowance payment, parenting payment or special benefits payment, or if after the 1st of January 2020 you were made redundant, your working hours were reduced by 20% or more, or if you're a sole trader and your business was suspended, or if there's been a reduction in your turnover of more than 20%, then you're eligible to do that. Now, the government have now opened up the means to do that for people that are both members of SMSF and other super funds, and that is you need to jump onto MyGov. There's a link there that will say register your interest to withdraw or to access your superannuation early, and somebody will be in touch with you from there. So for a short-term cash injection, if that's what you need to do and you're eligible, that's how you do it. Many of you will now know that pension minimums have been halved for the 19-20 year and also the 2021 financial year. A lot of people are asking if they've already withdrawn the minimum, and now that it's been halved, can they put it back in? And the answer is unfortunately no. The next item I'd like to talk about is rent relief for related party transactions. So for those clients or those of you that have a business real property or that receive rent into a self-managed super fund, you do have the ability to suspend periods, to suspend rent for a 6-month period or whatever a commercial period may be. So if that affects you and that's something that you could benefit from, then you really need to speak to your advisor about what's involved and how to do that in a compliant manner. Again, with pensions, we say you can consider a stop and a restart of pensions. Obviously, people that exceed the $1.6 million pension cap could benefit from a stop and restart in some circumstances. So that's something to talk to your advisor about. Another item that we've mentioned is to consider your death benefit nomination at these point in times. Make sure that your superannuation death benefit nomination is up to date and valid, because your super is not automatically dealt with as part of your will. And finally, without being morbid, if you don't have a will, you really need to get one. So that's something that Prime can actually assist you with as well. So now that I've been through the superannuation component, I'll move on to the Q&As. And I'll start with you, Jono, with what are your views on short to long-term interest rates? He's just muted himself. We'll wait for you to unmute, Jono.
I'll take that one while he's
okay, go Cam.
Unmuted. So basically, we expect interest rates to remain low. I think there's every chance that the RBA might actually cut interest rates from here further. I think for anyone to think that interest rates are going to go up, all of that spare capacity in the system that John has been talking about would need to become a lot more strained, and there's excess capacity to be used up. So if that were the case, then you'd see inflation starting to creep higher, which I think every central banker around the world would actually love to see a bit of inflation in the world at the moment, but it just doesn't seem to be today's problem. And it really doesn't, to be honest, seem to be a medium to longer term expectation of inflation rearing its head. So I think the bond markets are sort of paying yields of about 10 years of only 1% or so, and that's giving you every indication that the bond markets are expecting interest rates to remain low for the next 10 years.
Yep.
Completely agree with all of that.
Good. So this one is for you, Jono. It says a lot of your charts and commentary is USA based. So why not Australia or Asia Pacific? Given most of our investments are Australian based, but only a small percentage are global.
Okay, well, certainly within the recommended portfolios, we would like more people to be more exposed offshore, because the Australian market is not even 2% of global asset markets. And I'm probably saying things to everybody that you've heard me say before, so I apologise, but I think it's important. We have a very limited economy here and a very limited market, and it's dominated by banks and resources companies, and latterly a couple of really successful healthcare companies have done well. But many of the leading industries globally can't be found in the Australian equity market. And other asset markets locally here, such as hybrids in particular, are tied to the banking sector, which is a big part of the equity market, and tied to housing, which is also having second and third derivative impacts on portfolios as well, either through banks and the like. So it's a very concentrated market, and we would prefer investors to have an increasing weight to offshore asset markets. And so we focus in large part on that because it's a preference for us, because we think that you'll make better returns offshore, and the proof is in the pudding. In the last 6 months, the last 12 months, the last 5 years, that returns from offshore equities have been significantly better than they have been from local markets. But the diversification issue is a big one. But also too, just in really simple terms, even if perhaps your portfolio might not be as exposed to offshore, it's the United States and China that dominate the global economy. And so what happens there has a knock-on impact to our economy. And so that's why I think I and probably other people doing my job tend to have quite a significant focus on the US, and certainly from the coronavirus standpoint, I think it's the epicenter of how we as a globe or as a world exit to the other side of these things. Is hugely dependent upon how the US exits its current quarantine. I hope that helps.
Yeah. Okay, so Mitch has a great comment here. So do I understand that you believe this to be a dead cat bounce and we can expect new lows to be formed in the market over the coming months, or do you feel this is a sustained, albeit slow, rally?
Yeah, listen, I don't know if we're going to go. I don't know, Mitch, that we'll go to new lows. I don't think this is the start of a sustained rally at all. I think that we're probably moving into much more of a sideways market, particularly in Australia, but I think globally as well. Because back to those points, I think that return on equity is going to decline. I don't think we're going to get a rapid rebound back in the global economy. So I think this is probably a bear market rally, but I'm not so confident to say that we're going to roll straight back down again to new lows. I think that's probably less likely, but I go back to the first slide. The uncertainty on this virus is such that you wouldn't rule it out. I mean, again, as of this morning, there's a credible presentation suggesting that we might be forced into rolling quarantines for the better part of 18 months. It's desperately unknowable. So what I would say with what we're doing on the portfolios is we don't feel pressured by this rally that we're going to miss out on significant returns. And we would rather, even if I'm buying the market at the same levels as we are in 3 months' time, but doing so with greater confidence, I'd rather do that than be sort of speculating, if you will, on a likely outcome from following this quarantine period that frankly is just speculation.
Okay. Cam, have you got any comments or feedback on what you think the property market's going to do over the next few years, both residential and commercial?
Yeah, so I think they're certainly going to have an impact on both. So on the commercial property, having a look at foot traffic through shopping malls, it certainly has been massively impacted currently, and there's an increasing expectation that foot traffic numbers might actually not go back to what they were before this virus. It's going to change consumer behaviours, and everyone's being forced to buy stuff online at the moment. So we do envisage the commercial real estate within that retail sector to be a little bit weaker. It's going to be interesting to see how quickly people move back from working from home back to offices, and employers, whether they're going to need as much office space as they used to, because the workforce is increasingly flexible, and this has been a great experiment to show how it all does work, and we're living and breathing it, and it certainly does work. So I think over time there will certainly be the immediate impact on people not being able to pay office rents, but longer term the demand for office space is likely to come off a little. Warehouses, probably I'd be interested in Jono's view as well, but I think the global trade of goods demand's fallen away a little bit, so there's going to be a little bit of a lowering in the transportation of goods around the world, but it's probably going to be less impacted than offices and retail. And then on the residential property, well, you see the clearance rates on the mortgages, clearance rates on the auctions on the weekend really falling off a cliff currently, and it's hard to imagine people having a great amount of confidence to go through an auction process over the next year or two as this all plays out. So that is going to have a negative impact on prices over the next year or two.
I'll pick up on that on the property side. I mean, I completely agree with Cam. Auction clearance rates fallen into the high 40s, low 50s, where they got to a couple of years ago. That's indicative of 10 to 15% national house price fall, not unlike what we got back in 2018. Again, if you just think about the consumer behaviour issues, you know, if you've just had your cash flow smashed for a couple of months, you are hardly going to be in a position of confidence to go out bidding on a house. And I would argue that, again, as we see through all of these types of economic slowdowns, people go to cash in all forms. So, you know, to Cam's point, I think we're probably going to see more people taking leverage down and selling properties, etc., in the coming 12 or 18 months. And then on a medium-term view, and this is me speculating, but doing so, I think from a sort of slightly credible viewpoint, you know, Mr. Morrison has said that he's not going to curb franking in the near term, and I think that's fair. But capital gains tax and franking and you know, various other tax efficiencies available in the investment markets, such as negative gearing, have the potential to emerge as issues in a couple of years' time as means to pay for the explosion in government debt. So I think that the housing market is going to be pressured for the next 12, 18 months, exactly as Cam insinuated.
Okay.
I can see the questions here, Liv. Do you want me to?
Michael from Perth.
Do you want me to jump into?
I'll just read them out for the.
Okay. Yep.
Sure. I'll read them out for the viewers. What do you forecast bank dividends to be in the next 12 months, and when do you recommend investors get back into bank stocks?
Yep. Hi, Mike. Listen, it's hard to know. UBS have the best banks analyst in the market, in my opinion, and he cut his dividend expectations for the three big banks that March and September interim reports, so Westpac, NAB and ANZ. He cut their interim for this half ending a couple of weeks ago to 0. And then have them restarting at the September dividend payment, which comes in May again, but at a rate of about 50 cents a share for each of the three, and is looking for an annual dividend on those three in the following year, 2021, and then again in 2022 of around $1 a share, and rising in the case of NAB to $1.20. So at current levels, where they're all about $16 give or take, you're looking at a fully franked yield in the 6s, but it's going to take you a year to get there. Banks are now trading underneath book value. I would argue that they deserve to be underneath their book value because they're not returning their cost of capital at the moment. I think that it's hard to get excited by the banks in the near term because they're very well owned by retail investors for the dividend, and really for the course of the next 8 months, it's unlikely that they'll get one. And I think that'll be quite a shock to a lot of people when the results come out at the end of this month and early May. But they've done a huge amount of work. As I say, they're trading below book value. So don't hold me on this, Mike, but I would say 15% below where we are, you'll see some value investors coming in and buying the banks on the longer term basis.
Good. And I think the final question, which I'll open to all of us, because it really is the $1 million question from Tony, which is your time predictions. Kids returning to school, kids returning to sport, normal retail trading.
Yeah. So this week, Tony, you've got Austria and Denmark coming out of their quarantines in Europe, and I think everybody's watching them to see how they go. Sadly, in Singapore sadly in Singapore and also too in Korea, they've had some flare-ups and had to, particularly in Singapore, had to retighten things back down again. So a lot of people are watching what's going on in Austria and Denmark this week and next week to see how things look into May as to whether or not they get any flare-ups again in infections. Just as a guide, this Wednesday, retail shops up to 400 square metres reopen. but in Austria, and they will reopen where everybody has to wear a mask. There'll be a limit of 4 people in a shop. And then if they don't get the flare-ups at the end of this month, 1st of May, they'll open the shopping centres up and they'll go from there. I think this is probably a pretty credible means that other countries will follow. And again, just trying to take into account the comments that both the Premier in Victoria and the Prime Minister have made, you know, I would say that we will be doing the same thing here in 4 weeks' time. I'm also saying it from the position of hope as a father of 3, with them all driving one another up the wall at the moment as well. Listen, I don't know if the kids will be back at school at the end of this, before the end of this term. There's this, you know, if I was putting money either way, I'd probably say that they will. But it might, as I say, it might be six or 8 weeks away. It's hard to know. And then on mass gatherings and the like, I mean, you know, that normality I think is a long way off. And particularly here in Australia, because we're about to go into winter. So, you know, it's probably not the ideal time for us to be easing up. Whereas in the US, that transmission rate probably, and the northern hemisphere in general, becomes a bit easier because of the heat. You know, it's hard to see like the NRL going back as they planned. So it's hard to be optimistic on mass gatherings for really, frankly, you know, 3 or 4 months. But listen, I just caveat all of this by saying, yes, I've done a lot of reading on this, but I'm no expert. I do think though within 4 weeks that we'll start to see a bit of an easing on what it is that we're allowed to do here in Australia. Yeah.
Okay, so I think we'll finish up there for today. So just a reminder that today's presentation was general advice only. We will be sending you a copy of this video in the next day or so, and we'll continue to keep you updated over the coming weeks. So in the meantime, stay safe, but more importantly, stay sane. So thanks for joining us. We'll see you again.